Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. Good morning, everybody. Hold on a second here. I want to turn on the algorithm. Not that it will take any trades during all this stuff, but... All right, guys. So we got retail sales here coming in just a few moments. I'm not going to go to the charts. We'll look at the charts after the news. But both the CPI and the PPI numbers came in lighter than expected. That doesn't necessarily mean that we're out of the woods on inflation, but it does mean that there was a great number of political commentators and economists that believed that we were going to be in hyperinflation at this point that were dead wrong. But to try and figure out, you know, what's going to happen in the future, should we still be concerned about inflation? Should we be concerned about growth? Retail sales is going to provide us some valuable insight into that. So this ends up being a pretty big number. Well, we are looking for a reading U.S. retail sales month over month of spot 1 and a core retail sales number of spot 3. So I would pay more attention to that core retail sales number because cars is in that headline number. Cars have been, you know, not doing so well. So if that core retail sales number was under expectations, especially if it was like negative, that could be a significant change. That might be the thing that locks us into doing rate cuts in September, perhaps. So let's see how it goes. Okay, so we're down just a tad there on the knee-jerk reaction. Okay, so interesting. Core retail sales was 0.5 versus a 0.3, and the headline was 0.6 versus 0.1. So that's probably going to hurt the Treasuries a fair amount. That might actually, is that enough to be like, we don't get rate cuts in September? I think there's still a really good chance of it happening in September, but it definitely makes it a lot more uncertain to me. Okay, so the dollar is moving up. Good 10 cents there. Treasuries took a hit. You know, the thing is that the Treasuries have been selling overnight anyways, so so now is a really good time to come and look at the charts because we do have some interesting stuff. Yesterday, Donald Trump coming in and criticizing Powell and saying maybe he's going to fire him. Apparently they showed a draft order to the congressional members and asked if they would support it or not. I think there are some people in Congress that are even more on board with the get rid of Powell than Trump is. But then they asked him at a press conference and he said no, he's not thinking about doing that right now. So the Treasuries took a huge hit when that happened and then recovered back to it. And it was an okay day for the Treasuries. Now in the overnight, we've seen some pressure. And I think we'll continue to see some pressure throughout this session due to this you know, the flows seem to be down. Maybe we can sort out why that is. But then the retail sales. S&P 500. You can see they really took it hard. Well, something else I must point out is that the yield curve here spiked like crazy. So the 30-year went down way more than the 10-year did. Okay. Oil kind of okay. There's nothing too significant there. Gold at the bottom of its range. Silver seems to be handling it much better. Copper still doing that flagging pattern. Japanese yen kind of looks like they might be breaching some critical levels from yesterday. So that looks a little bit more dire than what we had in the treasuries. Bitcoin, well, they're still doing okay. They're holding some of those gains. Okay, my back really hurts for some reason at the moment. I'm going to go and try and roll it out, okay? Feels a little better. Kind of weird. Kind of a weird feeling where it's like over here, but I think that it was down here where things were kind of unhappy. All right, well, you know, the reaction to this retail sales, I think it's an important number. I think you got a really strong number. The market reaction to it is very muted. Very muted. I'm interested to see if our algorithm, after the pullback here, gets a short. It still seems to be a little bit biased towards longs. Senate passes Doge rescissions bill and heads for House vote. Oh, very good. Dollar snapped back from widely hated to painfully ripping. Headline on zero hedge there. The dollar is definitely looking good today. Wait, let's come back over here to this chart. Here's your dollar. I don't know if I would necessarily call it ripping, but that's an awfully nice trend, man. Awfully nice trend. And here today, up even more. Okay, the treasuries are reverting back to the open. Very interesting. I'm not seeing a huge impulse there, but from the numbers that I'm seeing, I do think that we have another possible trapped traders setup. I think that we would need to get above 16 to really start to see that volume come through, but Isn't that always the way that it is? Is it's like it gets there and then we're like, well, it needs to get to this, but then it doesn't get to this and it continues selling. So we're still at the decision point where this is kind of one of those spots that I think are a little bit more uncertain. Let's just keep an eye on it here. Oh my gosh, here's a tweet from Sam Altman. This is the first thing I've heard him say that I really think reflects my own view on AI and like not just reflects my view, but kind of resonates with me. He says, I agree with lots of what Jensen has been saying about AI and jobs. There is a ton of stuff to do in the world. People will, one, do a lot more than they could do before. Ability and expectation will both go up. Two, people will still care very much about other people and what they do. And three, people will still be driven by creating and being useful to others. For sure, jobs will be different, and maybe the jobs of the future will look like playing games to us today while still being very meaningful to those people of the future. People of the past might say that about us. But betting against humanity's ability to want more stuff, find new ways to play status games, ability to find new methods for creative expression, etc., is always a bad bet. Maybe human money and machine money will be totally different things. Who knows, but we have a lot of main character and energy more to come. I think he's absolutely right. And by the way, I really like that he brings up this idea that maybe you will have human money and machine money. Not because I necessarily think that it would be a really great idea to like separate out what, you know, machines make and humans make. But one of the things that I have found in video games is you start out with the game and you'll have some sort of incentive system, some system that allows you to make money, right? And then you want to introduce a new system. You want to introduce a new kind of progression level thing on top of that. And what happens is the people that have already been playing a lot and have already accumulated a lot of wealth in this system, they kind of break that new incentive system. And so or you can do things like you'll come in and you'll be really successful over here in this system and then pull it over here to this system and completely break this system, and then it makes this system OP and all of these things. And so how do you deal with that? And in games, usually what they do is they introduce a different currency type. And so that's why you see all of these mobile games where there's like 4 different ways of making money. Like there's the main one, and then there's another one for special abilities, and then there's another one that is like converts into cash, right? And I think that might be something we see in the future. Maybe not necessarily between humans and machines, but yeah, probably ways of like separating out the two. And maybe there would be conversions between the two, but limited conversions. Could absolutely be a thing. I think Sam is onto a whole, like, one of the things that really bothers me with the artificial intelligence discussion is that everybody online is obsessed with AGI. And I really don't think that, or it's not just AGI, sorry. They're obsessed with UBI, Universal Basic Income, because ultimately they just don't want to work. And we're not discussing a whole slew of other things I think are way more interesting and way more likely. So I'm just going to highlight that Twitter post to you. That seems like a post that could have a significant impact on the discussion. Well, at least I hope. Okay, so you know what I think happened here? My algorithm, I didn't enable it until just before the stream started, and it wanted to take a long before we started the stream. If I had it enabled, then it would have seen the exit there and it would have exited, but it didn't see it. But we did cross, and I should have done it earlier. I should have done it at 15. We did cross the threshold. It would have gone and triggered long. You think the 30-year is going to try and get back to 5%? Okay. So my micros are saying 4.857. Are you saying that it's actually above 5% by some other measure? Where's the high? The high is 5.164. Oh man, that is such a crazy spread. So we would kind of need to look at the broker tech numbers to see where it actually is at, huh? Hatsu says no, open. Now I took a little bet here, long. I'm betting that there should be a little bit more puking. Although on this one, I can tolerate a little bit of a pullback. You know, I usually don't like to put my stop out there because I feel like it makes me a target. But I think if we were to come down to 14, that would kind of change my opinion of it. But I'm thinking that we'll continue to see some of these contracts come out long. I think that the news was objectively a sell. So to see us bust the high here really suggests to me that it wasn't just like the people closing their position, maybe. Well, I suppose if it was just like they took the short and then they realized it wasn't enough and they took their profits, that could absolutely cause it to like push a little bit higher than it started at here. Because you got the liquidity hole. Of course, you have the liquidity hole on the way down as well. So, but I kind of think that we may have created a situation where you get a lot of trapped trade positions. Because most of these positions are from 14 and below. So all these guys, all this volume, you see that? They're trapped. The last day is interesting. The news comes out about firing Powell. Okay, so that whole thing was really wild to me because his rejection wasn't really a rejection in my mind. Like, okay, so what happened? Donald Trump gave has a draft order, and he showed it to Republican members of Congress, and then there was a story about it. That's what happened. And then they, and he said in the meeting that he was likely to do it. I think that that's kind of bluster. I think that that was a trial balloon. I think that that was a trial balloon, both to see how much support was for it in Congress and to see how the market might react to it. So then he has a press conference and they immediately ask him about it, and he says he's not looking to fire Powell. But then he admits that the whole story was true. So, yeah, the market treated it as, well, it's okay, we come. But, they came back. It's okay, we'll come back. But, it's just, it wasn't necessarily a denial. It was just, well, I don't want the markets to go down because of it. That's kind of how I felt about it. But you know what? I really don't think that it's going to happen. So a couple of points here. First of all, oh man, this gets into a really weird discussion. Okay, can Donald Trump actually fire Powell? Well, no, but actually, yes. I actually think that the answer is kind of yes. Amir says no, and I would probably naturally say no as well. So the Federal Reserve is set up to be an independent agency, because we know that the politicians are always going to have a tendency to want to keep interest rates low. So the Federal Reserve is supposed to be an independent agency with its mandates, right? There is no provision within the laws that created the Federal Reserve that allows the president to fire the Federal Reserve president without cause. The problem is that he can fire it for cause, and there's absolutely nothing in there that really says explicitly what cause is. So, yes, he could come in and he could say, well, Chairman Powell's renovation of the Federal Reserve facilities. Hold on, let's start the music back up. His renovation of the facilities was too expensive, and that is cause for firing him. It's just like if you're at work, right, and they want to get rid of you, and it doesn't matter how good you are or how well you're within the rules and how well you perform, they put you on a PIP and you perform that PIP perfectly. They want you gone, they're going to get rid of you. And the government, or sorry, the company, all the PIP is a way for them to create a paper trail so that when you come back and sue them for, saying that you were unfairly fired, they can say, no, look, see how terrible of an employee he was? It's the same thing. It's the same thing. He can come in and he can say, well, he shouldn't be, we're firing him. He's not chairman of the board anymore, and here's for cause. Now, that is kind of like the yes. But the thing is that it wouldn't just be like immediately like he would be fired, but then probably there would be a court case. Now let's try and game out the court case. Well, that takes several months, if not years, to work its way through the system. And what's the argument going to be? And in the meantime, the markets are going to be without a chairman? Or is he going to be able to be allowed to just install an interim chairman at that point? And would the courts, I'm sure that some activist judge will say, nope, you can't do that. Stop him. How long would it take to get to the Supreme Court? And by the time it gets there, would it even matter anymore? It would be to the point where Powell's term would be ending. Okay. So let me tell you something about predicting, especially when you're trying to predict like things on the global world stage. How do you predict? Ignore what they say and look at the options in front of them and the positives and negatives of the options in front of them. Political leaders are kind of learned to say things that will help them, even if they don't reflect what they're going to do. It can kind of help to say I'm going to do one thing and then end up doing the other thing. Donald Trump definitely understands this. So we can't read his mind. We can't read his mind and is it that he just really, really, really wants Powell gone that badly? Or does he know that that's impractical but he just wants to pressure the Federal Reserve somehow? I don't know. I can't say for sure, but what I can say for sure is that firing him would be a really foolish decision. He wouldn't accomplish anything for him. It would create this huge firestorm, would substantially harm markets, and he wouldn't actually get anything out of it because by the time the court cases are done, it would have been time for Powell's term to end anyways. So that's the funny thing is he's not supposed to be able to fire the chairman of the board, but I think actually in practical terms, he can fire him, but he won't, is what I think. So my play is if I see the market go down on comments from Donald Trump that he's going to fire chairman of the board, I'm buying the dip. That's my plan. That's my plan. Why do you think he really wants to? Well, I don't know if he really wants. I think that he wants to fire him, but I don't think that he actually has the plan to do it. Like he wants to do it, but he knows that it's a bad idea. That's my own personal opinion. I'm not a mind reader, but based on what I know of Donald Trump, and I feel like I've been pretty good at predicting what Donald Trump is going to do when many people have been terrible at this, right? I think that he wants lower interest rates. He wants to get rid of the chairman of the board, but that he knows it's a foolish decision. And so what he's going to do instead is he's just going to talk about doing it in the hopes that talking about it will perhaps move things in his direction. That's what I think. So now the thing that I think is kind of funny about all of this, the reason that he was bringing this up yesterday was because we had that PPI number and the PPI was not increasing. Okay, well, so first of all, exports are excluded from PPI. Okay. I didn't know this, but I actually learned this from Ethan Clark. I think he's a really good. You know how I know that Ethan Clark is a good economist? He doesn't make predictions. A good economist knows how limited their ability to actually predict things are, and he focuses on just understanding what the numbers are and what the numbers have been in the past, and he doesn't necessarily make explicit predictions, right? Super cool. Maybe I should be more like that, but we trade. We have to make predictions, right? PPI number is excluded. So first of all, I don't know if PPI tells us that much about inflation. I mean, it still tells us a little bit about inflation because those inflationary prices are going to fall through into domestic producer price, right? So it still matters. Okay. But it's not a huge deal. I think CPI is more of a bigger deal of like, is it resulting in higher prices for consumers, right? A lot of people predicted that we were going to see runaway inflation right now, and they were dead wrong. And so I think that the administration is absolutely correct to come out here and say, you know what? A lot of people were wrong about this. Absolutely. But you know why they were wrong about it? Because it's very hard to have runaway inflation when when monetary policy is so tight. And it really is extremely tight right now. It is. Look at the tech sector, man. The tech sector is really hurting. We're seeing like artificial intelligence and Nvidia is going up like crazy and all this stuff, but they're not hiring. All of those companies are slimming down because interest rates are so high and they can't borrow to grow. So it's absolutely holding things back. The policy is too tight for I mean, that's kind of, again, this comes back to the thing I was saying earlier about maybe you need multiple currencies. There are some things that, like the tech sector, that need low interest rates to grow. And there are other things that kind of benefit from higher interest rates. Like, I don't know, like insurance companies, I would say banks benefit from higher interest rates. And one of the issues we've had in our economy is for the last 20 years is that interest rates were low. And so only the companies that do really well when interest rates are low grew. And the companies that when you have higher interest rates didn't grow. And there's no balance to it. You only get one interest rate. It would be kind of nice if we could come up with a way to say the Federal Reserve actually controls multiple interest rates and the interest rates change depending on... I don't see how you would practically do that. I don't think that would really make sense. Donald Trump wants the Federal Reserve to cut interest rates. He keeps saying that it should basically be zero, which is crazy. Okay, that has to be hyperbole, bluster, right? Okay, if the Federal Reserve cut interest rates by 3 whole percentage points overnight, that would be crazy. It would absolutely create carnage and inflation. I think so. It would probably be not as dramatic as I have initially envisioned in my mind, but I think that it would create inflation, absolutely. So the whole thing here is that these economists have been wrong. We haven't seen too much inflation, and Donald Trump wants to basically get in the way and change the one thing that has kind of kept things together here. Isn't that crazy? Isn't that crazy? It's just, if Donald Trump actually had his way, it probably would be super, super bad for him. But I'm telling you, he's not going to do that. We're probably, I still think, man, this one is a hard time. Every time that I put myself on record saying this, because I know that the tendency is that when we think that there's rate increases or decreases coming along the way, it happens much later than we predict. And I'm not just saying me. When I say we, I mean like the financial and economic industry as a whole. You can go and you can look at all of the analyst expectations and then the actual, and the analyst expectations are always ahead of what actually happens. But I think that we will get a rate cut in September. I think that some industries, the housing industry, the tech industry, really, really need it. I think that the high interest rate is doing more harm than good right now, even though we do still need to have interest rates relatively high to keep inflation under control with these tariffs and during this transition period for tariffs. Because I tell you what, man, yeah, it's been 6 months we haven't seen massive inflation, but we're probably going to be seeing the after effects of tariffs for years. So don't think that we're out of the woods yet, okay? That's why I think that if we cut interest rates too aggressively right now, it could really cause problems. But I do think that we could probably cut interest rates 25 or 50 basis points. Do 2 cuts, kind of see where things go. And that's what I think is going to happen. I really hope Powell is acting in good faith. I don't trust him. Well, that's really why do you not trust him? You know what? I think that the Federal Reserve behavior does not make sense. It doesn't make sense. Where was it? Let's come back to this. A zero hedge showed it perfectly yesterday. You really did. It might take me a second to find here. Stick with me, guys. Stick with me. I think it was this one. No, it wasn't this one. Maybe it was their market synopsis at the end of the day. Yeah, right here. This is zero hedge. Dear Mr. Powell, explain why you cut rates then and not now. Well, growth macro data is considerably weaker than it was then. So here's this chart they've got here, right? And they're showing like the macro data, and we're a good move down from where that was when they cut. I saw another one showing, it was this one right here. Explain why you cut when inflation signals were considerably higher then than they are now. Yeah. Inflation and all of these things was higher over here than it was over here. Why did we cut? I get stuck on this one because I remember them doing it, and I remember it being a 50 basis point cut and being like, what? What? It didn't make any sense. And there was a lot of people saying, well, they're doing it to help Biden. And I said, well, I don't know if that makes sense. I think that you can justify it with the market data. And you know, at the time I was like, yeah, you know what, 50 basis points. Okay, that's okay. Because the labor market was having problems. So like you can justify it then. But you can't justify doing it then and not now. I understand the thing that's like, well, there's tariffs and we can wait to see on tariffs. But like, it's been 6 months. Come on. We should be cutting in September. And if we don't cut in September, then I'm definitely going to be I'm going to be inching a little bit closer to you guys here that say that the Federal Reserve is acting politically. Because it just doesn't make sense to me that they would cut that in on now. Now, with that said, like it is still within the margin of error. I don't know if like that they cut in September versus this month really makes a huge difference. The thing is like, do you cut rates then to help the Democrats? Did it really help the Democrats? I don't think it did. Like, well, first of all, Donald Trump won. But number two, I really don't think that anybody was sitting there at the election going, well, I want to vote for Democrats because things have been going so well for, like if they were going to do a cut to help Democrats, they would have needed to have done it way earlier because the effects of monetary policy are delayed. It takes like 6 months to really see the full impact of those things anyways. Like we're only now getting to, well, I guess we're almost coming on a year on that one. Okay. But we're, we didn't see the impacts of that rate cut really in the economy until after the election. So how is that going to help him? Right? That doesn't make sense. I personally, I don't think that Jerome Powell is saying to himself, well, I really hate Donald Trump. And so I think that anything that I can do to hurt him in the economy right now will be a good thing. I really don't think he says that. First of all, the people that are involved at the Federal Reserve really take this seriously, and I don't think that any of them would consciously do that. Number two, what would the point of that be? You're gonna hurt Donald Trump now, like it's his second term. Unless something really, really crazy happens and he somehow gets a third term. I don't think he's gonna serve a third term. Okay, you're gonna get a different guy in 4 years. So where does it matter what you do with Donald Trump? I don't think it's that. I think that the board overall has unconscious biases, though. I think that there's unconscious biases. And yes, because of the mental place that they are in politically, they may be a little bit more hawkish than normal. But that's where it's kind of like, there's this wiggle room that they get, right? And that's where I say, like, if September, I think we should have a rate cut. If we get to the end of this year and we still don't get rate cuts, and the data still supports the cuts, that's another thing is, listen, the data could totally change between now and then. Okay, we got another month of data before September. If we have another really, really good consumer retail sales report, then that changes everything, right? But if the data continues to come in the trajectory that it has been and everything, and we don't cut rates by the end of the year, they're out of wiggle room now. Now it really is, they should have been cutting and they're not. And what the heck is going on, right? You say it's BAM at 5% now? Okay. Well, on my side, I'm thinking about where should I take profits on this little sim trade that I took. Well, it's, let's see here. Oh, I should always take it off at 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I pray for the midterm, just nothing could cause more political turmoil. No, because the thing with the midterm is that Democrats have a lot more seats in jeopardy than Republicans do, like considerably more. It's basically like for Democrats to take over the House, they would have to have complete and total victory. Basically, every seat that's competitive, they would have to win. So midterms probably aren't going to change very much politically. I know a lot of people online and the Democrats are kind of like looking forward to it and like, oh, surely all of this turmoil and everything, Donald Trump's going to do poorly and we'll do well in the midterms. Like, they've been kind of trained to think that way, but that's because they don't really know that the stakes for them aren't very good. But did you trade it October? Not sure what you mean by that. We took a sim trade in the 10-year Treasury. Go read my message that starts with woo. Oh, okay. I totally missed that, Paul. I'm sorry. I might have just passed the prop firm first part by less than $1. They'll probably have another excuse or slightly adjust the profit target again to make it to where I haven't gotten. That's funny. Are they getting you on a consistency rule? My guess is that it would be because of a consistency rule, huh? So they were going back and forth across 21. Now they're going back and forth across 20.5, and my target is at 21.5. So I'm not particularly liking that. I might just come down. Because I don't know if it's really worth it to wait. Like, that one is just like, usually I get 10 ticks, and if I hold it out for more than 10 ticks, my stats show that it's not as good after that. So, but the DOM is telling me one of these two prices. Yeah. It's done that too many times. I'll take it off there. Do you use no, not necessarily. If I were to use the cost basis to get out, I think that would have to put us like way up at like 24.5 or something. So let's go back. This is actually really interesting. So both the long and the short cost bases are unusually far away. They are unusually far away. After having such a good, strong trend, we would normally be like bumping up against it now, but it's gone. And why is that? Well, because we've had pretty decent moves both ways. And so it looks like there has been opportunities for market makers to make considerable profits both ways. In other words, I think that when we were down in here, there were speculators that were caught off guards, which might have been what resulted in this whole thing, right? But the market makers aren't necessarily under strain. And so there's probably a good chance that they mean revert a little bit here. This will probably come up, but like maybe they mean revert to here. That's kind of what I'm thinking. Note, there was a big sell impulse right there. That's also kind of just one kind of little hint. Just maybe one kind of little hint about where we're at. So, that's kind of where I was like, I'm expecting a liquidity hole to form up here somewhere. I'm not, I don't know. When you look at the price action, you might be seeing stuff that makes you think that it's going to flip back down, right? I've got to ignore that part. We need to, this bar is going to throw us off, right? But that bar right there. This bar I think matters because there was significant change in cumulative delta on that bar. So I might be getting out a little bit early, but so far I've made the right choice. I tell you, this is, I think, one of the hardest things is I'm starting to learn with this. Well, first of all, the algorithm definitely has streakiness. There's periods where it works really, really well, and there's periods where it doesn't work very well. But another thing that I found is that fighting for that 1 or 2 ticks on each side makes a huge difference. It really makes a huge difference. So how do you get that 1 or 2 ticks? It's awfully hard because every time there's a lot of randomness around that. But that's what I'm looking at. Check Sierra. Yeah. Sierra charts are showing pretty much the same thing. Actually, I am seeing a few. Let's go back to this chart book. There's still some things about this one where I think that they're like resetting at different times and there's other things different with it. The raw chart book still seems more correct. There is slight difference in volume there, but that is showing exactly the same thing as my Ninja Trader one. This one is different. This one, it's like, look, the seller break even is way out there. Why is that? Why is this one broken? But my chart book is fine. Or the one where you just use a raw chart. So I don't know what's with that. I what I'm seeing right now still says to me that the algorithm is correct, but that there are settings in Sierra chart that can affect it and that we don't understand. It resets there at 1500. One of the things I don't like is that it doesn't tell me very well which bar I have my mouse over. This reset is at a different time. I thought I changed that. Session times. Oh, maybe I changed it back to show you guys that that's definitely what it was. And okay, well now it's resetting at the right time there. But there's still something else different. Don't know what it is. Don't really have a good way to figure it out either. We just have to continue coming in here and go into the chart settings and saying, what's different? I wish, can I now see when I have one of these windows open, it basically makes, I don't think that I can, well, actually maybe can I go here? Yeah, then it closes. So I can't look at the settings side by side to compare them. So what I have to do is session times, take a picture, open paint, paste the picture, cool, okay, Seth, chart settings, compare, 1600, 1559, no. Okay, the evening start time is different. This says, okay. $22, 21. Yes, load all weekend. Apply intraday time, session times to intraday chart. Yes, intraday chart global time zone. Okay. Still wrong. Verify one more time. Yes, load all weekend data. Yes, intraday data. Use global time zone. Okay. So it's not that. Control A will save the setting. Okay. Let's come back to the chart book that works. Can I just show all of them? Maybe. Auto set from data feed. No. Oh. I'm not even looking at ZN. What the hell, dude? EN. $22. $21. Yes. Yes. Okay. Oh, now it looks correct. Now it looks correct. Wait, it's off from Ninja. No, it looks the same to me. You get a little spike here and a spike here, and you can see that on Ninja. Especially if I change the scale here in Ninja so you can really see it. Oh my gosh. Make it big again. Yeah. There's maybe tiny little differences, but those differences can probably be explained in the difference between data feeds. But it's 25 versus 22.5. Oh. Oh. No, you're totally right. In Ninja Trader, it's giving 25 and over. Oh, well, but well, I don't know though. Oh, that is weird. Okay, so this peak right here was 23 and this peak over here was 24. Well, there's so this data feed is ahead of this data feed by 10 minutes. So there's that. That's why really if I look at like, oh my gosh. Yeah, if I look at that one spike, this spike was explicitly at 24. And this spike was explicitly at 23. So it's one price off. So that could 2 ticks off be explained by data feeds? I don't know. I kind of feel like no. But I'll take another look at the algorithm in CR charts and see. Maybe it's there's another piece of logic where they're not quite matching where we would like. So I don't know. By the way, where did we get out again? We got out at gosh, I hate when it does this. Oh, it's not going to tell me the last bit. But it was 16 half. It was 10 from 16 half. 1, 2, 3, 4, 5, 6, 7, 8. Oh, 8. Was that 20 half? Okay, yeah. So we might have been able to get one tick more. But it has been spending a lot of time here. There was a pullback before that happened. So I'm going to say overall I made the right choice. I never finished my oatmeal. Oh, Paul got the message that he passed? That's so good. I find it really fascinating that the A-Pulse had success with it, like, right from the get-go, too. That bid is looking a little bit better now. So 3,700 at 20 half. So at least we might get the fill at 21 now. Okay, that was a good tick too. So maybe they will push further now. Okay, there it is. So there's still a little bit of back and forth at 21 half, but if I had held out for the 10 ticks, I would have gotten it eventually. I don't think that I wanted to sit through. How far back did it come back to 18? So it came all the way back to here. Yeah, that's enough of a pullback that for me, with the way that we're trading, I don't think that we want to sit through, although I guess I would probably have to do stats on that to really see for sure. One thing I will say is that we had a pretty sizable change in cumulative delta to push here, but it is coming back already. So, and here the S&P 500 is starting as well. That's tends to create a little bit of noise. Let's see here. I'm just thinking about things. The algo. I've been really bad at always turning it on the right spot. but it definitely would have caught a winner there. One of the things I noticed, I pulled up some stats on it, even though I don't know if the stats are really fully reflective of how it trades because I forget to turn it on so often. But and I was finding that it did really good during the period when we were sitting here watching. And then in the period where it traded after I left, it did terrible. Which was kind of weird because when I back tested it, it was showing that it really needed to have that period going into the London close to really do well. Chose them because I wanted to use Edge Pro X. I don't like it much, and I'm kind of stuck with it for now. That's interesting that you don't like it that much. But all the platforms, we really need to figure out a way to just start to get the resources to build our own platform, man. I really see the opportunity. FFN is supposed to allow bonds? Really? It'd be really interesting to run a... So one of the guys, so there's this kid. I'll call him a kid because he's still in college. I don't want to call him a kid to be like, you know, or he's beneath us or anything like that. But I think his name is Delta Trend Trading or whatever. And he's started to amass a pretty decent following on TikTok. Doing what I was trying to do in the beginning, which was just totally trash on ICT every day. And he's doing back testing, he's going to school for this stuff. He understands it really well. And I don't think that he necessarily understands the complexity thing or the momentum thing or the order flow thing, but he understands that markets are competitive and the fleeting nature of edge and all of that. And so he's started to go and back test certain popular strategies out there in TradingView and showing the problems with them. And I really like that. And I kind of feel like, you know, I have not been able to get through as much as I would like. This guy is. Let's let him do his thing because I care way more that the message gets out than that the message comes from me, right? So he's kind of showing people these things. And one of the things that he has on me, I think, like a big thing that he has on me that I really wish I could be spending more time on this, but is the machine learning. He's like, okay, well, then we can apply machine learning to this. It's super simple, yada, 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 which it is super simple. I want to feel like I understand what's going on, right? So he's kind of showing them things where it's like, well, okay, like you're doing this, but that doesn't really make sense because I can use like the Garch model to predict volatility, and I can use this to predict this thing, and can use this machine learning model to figure out the regimes and only trade it when it's in a good regime. Just something that we really need for our algorithm, right? But it still comes out to these retail strategies that they don't work, right? So like it does a really good job of, okay, well, most retail traders, most strategies that YouTubers are showing you aren't going to work. But I think that there's a couple of bigger kind of questions. I feel that what the majority of retail traders are trying to do is not going to work. Can you come in just using purely the market price data and trade and find a day trading edge in in either treasury or equity index futures. That's one, like, can we show me a strategy that would actually, you know, make more than costs? Make more than cost. It doesn't have to be a lot, but just it makes more than cost. And can we prove that that's possible? Because if we really can't find one of those, then that kind of means that pretty much what all retail traders are doing not going to work, unless you're informed. Perhaps informed might be the one loophole we can get through to find profitability, right? And the other one is, can you show something that it doesn't have to be perfect, doesn't have to be to like win all the time, but something that has a really, really low variance and will pass prop firms a lot. That would be kind of the other one. And he hasn't really gotten there yet, but maybe he will. But I kind of feel like I don't know if those two things that you're ever going to find them. Personally, you know? But it would be interesting to see a prop firm thing. Like what is one of those places where we could maybe dig for something? Spreads. Trading treasury spreads. That's a major thing that's like, we know a lot about it, but you know, we've never been able to find an explicit edge in it, even though we know that the spread trading is a significant portion of the market, right? And spread trading is something that I would venture to guess that the vast majority of the prop firms out there aren't going to let you do, or it would break the rules in some way. But I kind of think, because I remember John telling me this story that before I came in, so sometime around 2015-ish, that there was this guru that he had a whole room trading spreads, and that room did insanely well up until there was a big market rout, and then he was disgraced and everybody disappeared. And I kind of want to know what they were doing, to see like, okay, is this like a low variance, big fat tail kind of a strategy? Really interested in that. This is the FFN list of products. Oh, I see. So they do allow the treasuries. One of the things that is kind of a thing is like, the prop firms put strange limits, right? They don't say you can only use so much money in margin or anything like that. They just say you can only trade X contracts. So that in and of itself, I think is like huge red flag, right? Because what does it do? Basically means that it makes the most sense to trade equity indexes. They want you, they set the rules up to make you want to use equity indexes. And why do they want you to use equity indexes? Because they're more random. Just saying. That was a big buy there that came through. I tell you what, guys, coming back over here to this, I don't know. I might have been wrong about this. So the way that the algorithm trades, it takes the 10 ticks. And so for it to have gotten one tick away and not filled it and come back, I'm glad that I took the profits there. And I was mostly taking that trade because the robot didn't and I really liked it. Because I'm not quite sure I see what's driving the flow long here. I was not expecting to see this much of a flow long. So with the way that Seth trades, I don't think that I necessarily would have taken the trade. Only the technical one. But if I had, with the way that Seth trades, he might take it off from that, but Seth would prefer to still hold it. Seth would prefer to hold it as long as he can. And when you look at the chart, like, man, that is a good trend. This period since we were like, okay, are they going to clear it? They kind of almost didn't, and then they did, and ever since, that's a good move right there. I missed out on that. The only way that we could predict that is knowing how much flow is supposed to come through and saying, well, yeah, there's been a change of about 30,000. Now, over here, it was more like 20,000. But actually, there's like way more that needs to come through. So we should hold it. That's the only way. And since I didn't predict this flow, I don't know if I would be able to venture a guess about how much is going to come out from it. Wow, what might be this flow? I don't know, man. There might have been some degree of that didn't reach the bottom here. Might have been that this did hit a key resistance point. Let's see. Maybe let's go to a daily chart. Yeah. Oh, very interesting. Okay, so this whole move here, something that so this dotted line here is ATR stop. So basically, we're looking at multiple times. I think it's 3 times the daily average true range, and then we say if we pull back more than that average true range from the high, then we are in a different trend. That's what the indicator says. But what we find is that when we cross this line, that we tend to get mean reversion. There tends to be mean reversion. And so you can see it right here. They breached the line. And then what starts happening? Big ranges and down. So this is this line right here. Okay, so like if you're doing momentum, you use these trend lines, right? Because a significant factor behind what these do, right? But if you want to trade mean reversion, use the ATR stop. And the ATR stop is down in there. So I would consider, I'm not going to say it's like an exact price, but I would consider this zone here to be a key area of support that the sellers were not willing at all to test. So some of what we're seeing may just be mean reversion. Some of it may just be, yeah, we probably are going to cut interest rates in September. What else? Well, the S&P 500 seems to be doing okay-ish, so it can't be that. What about the dollar? Well, the dollar pulled back a little bit, and that has led to some continued strength in the yen. So, like, the yen kind of did its thing from here, but then this section right here is correlated with a pullback in the dollar. So it could be it could be some currency flows involved in there as well, or some dollar flows. So maybe, well, I don't know. Could you maybe say they're moving their money over into dollars over the past few weeks, and so that's kind of leading to maybe some money coming into treasuries? Except for that, it was only today and yesterday that they've been buying, so I don't know if that one really makes sense. Liquidity is back? Well, you know, that's actually a really good observation, Octavius. I think that's always something that I tend to miss. As we've moved up here, the stacks have been really strong, and we've got a lot of 5Ks down there. That's higher than usual. He says liquidity is back, but I can only remember a few periods where it was above 5. I can only remember a few periods where it was above 5. This suggests to me that there are some big players executing, and when they come in, they tend to come in and add liquidity. It's also very curious that there's not any of it on the offer at all, right? There's a very, very, very strong imbalance in favor of the buy. So that's really curious. Alan says, I'm new here. Yes, you are new here. I've never seen that name before. I immediately realized. You know what's funny is, you know how I know that you're new, Alan? Is that your name is not Blue. That's how tight-knit we are here. Almost everybody that's chatting this morning is a moderator. So, And then the other thing is the whole thing with Trump yesterday. Could the market be saying we think overall that the Federal Reserve is going to be forced to cut rates at some point? Or in September? I don't know. You know what? Let's come over here to Zero Hedge real quick. Let's see if they had any additional stories about this. Well, let's read this. U.S. retail sales surged in June despite all the dismal downbeat sentiment signals from various soft data. It appears the American consumer is not deterred from spend as U.S. retail sales surged spot 6 month over month in June, driving sales up 3.9% year over year. Under the hood, motor vehicles and auto parts sales surged in June. Yes, this is after tariffs went into place and not due to any front running. The control group, which feeds directly into GDP, also surged 0.5% month over month in June, leaving sales up 4% year over year. Of course, this data is all nominal, so we make a rough and ready approximate to real spending by reducing the sales by CPI, and voila, real retail sales have risen year over year for the last 9 months. So our spending outlooks from all these soft surveys, just a load of partisan BS, yes. The soft surveys I would ignore right now. That's not necessarily a good thing for interest rate cuts, though, right? So that doesn't explain why we're getting interest, why we're getting money coming up through here. Okay. Let's read a story from Simon Waite, Bloomberg macro strategist. I really, really love this guy. He has a lot of really good insights that are relevant to us in the treasuries. Money growth in China is showing clear signs of accelerating as stimulus begins to feed through. A sustained rise would be pivotal for U.S. and global rates, adding upward pressure to inflation just as price pressures are beginning to re-intensify and the independence of the world's most important central bank comes under attack. Federal Reserve Chair Jay Powell is staying put, or maybe he's not. The heat from the White House may yet become too intense, prompting the chair to quit. Either way, the bank's independence is being compromised just as a potential spark for global inflation is being lit. Money growth in China looks like it is on a clear upward track at last. The latest data released from this week showed an acceleration in M1's ascent, with the annual growth rate jumping to 4.6% from 2.3% the prior month and only 0.4% at the start of the year. Money in China is the single most important driver of global liquidity. It's easy to forget in a financial world dominated by the US that when it comes to money, China is the biggest player. China's M1 is larger than the US's M1 ex savings deposits and is a third of the G10's total M1. And here they show, here is China's, here is the United States, and here is the total of that. That is like the total money supply that comes out. Okay, so we're getting more money supply, and more money supply tends to put pressure on inflation. Yes. Although, if we come back through in this period, you know, up until 2020, China was printing a ton of money back then. Obviously, it's not nearly as much as the change there, but Okay, anyways. M1 in China is 16 trillion to the US is 8 trillion. The former measure had household demand deposits added in 2025 to bring it in line with the measure used in most other countries. In 2020, the US added savings deposits to M1 out of kilter with most other countries. Still, China's M1 is twice as large as it is in the US, while M2 is 2.5 times greater. But M1 is what matters most. Why? In general, M2 is a counter-cyclical measure. It typically includes savings deposits, but these often rise in times of risk aversion and fall when animal spirits are roused, which is why I strip savings deposits out of the post-2022 M1 for the US. M1, in contrast to M2, is mainly driven by demand deposits and therefore is more pro-cyclical. Why does all this matter? Money drives economic growth and it drives markets. It is created by central banks and central commercial banks, and when it rises, activity tends to pick up in the ensuing months. Crucially, therefore, it is a leading indicator, unlike more widely followed unemployment, inflation, and GDP. Growth in money in China is a key determinant of swings in global liquidity, much more than the US most of the time. As the top panel in the chart below shows, M1 in China closely mirrors the principal component of global M1. That's unlike US M1, which generally does not move with global liquidity. If growth in China money is sustained, then the implications for markets could be profound as global and US inflation revives. Inflation in the US had been easing back even though it remains above target. Nonetheless, there are growing signs that price growth is on its way back. China's M1 could well become the proverbial straw to break the camel's back. It's not only a key driver of global liquidity, it is also the best and most reliable predictor of the cyclical ups and downs of growth in China itself, and why PPI in the above chart is so likely to start rising. There were perma-bears and perma-bulls for China all through the 2010s, and there remains so today. Both have thus far been wrong. Instead, real M1 growth caught most of the cyclical swings in China's growth in real time over the last 20 years. As the chart above shows, real M1 leads to Li Qiang Index, a proxy for Chinese growth consisting of bank lending, rail freight, and electricity consumption by 3 to 6 months. The rise in M1 looks sustainable, with it being driven by a steady increase in the growth of corporate demand deposits, which has just gone positive. Firms are becoming more bullish, while household and government deposit growth is holding steady. Moreover, local government bond issuance is ramped up by over a third in the last year, while the growth rate in new CNY loans, including those to households, is rising. On top of that, bank stocks have been soaring, while floor space started for new houses looks to be pacing. Yields in China, which bottomed on President's Liberation Day, now stand at a one-year high. Also encouraging is that the state and private fixed asset investment are now rising on an annual basis. This is a long story, but we're getting there. To seal the deal that anticipated the cyclical rise in growth in China is real, the yield curve would ideally steepen. So far, money growth has risen in defiance of the curve's flattening, but a reversal here would vouchsafe a strong recovery. A legitimate pushback to this analysis is the possibility that the China multiplier to the rest of the world is not as large as it once was. That may be the case, but it may not have diminished much either. The de facto bilateral trade imbalance between the US and China, the main transmitter of China domestic policy to the rest of the world, is as large as it has ever been. There's also the risk that China and the US become more estranged, with trade significantly suffering, but that eventually would be bad for global economic and market conditions regardless of money growth in China. There is a sizable chance China is about to finally turn a corner, stoking global inflation and leading to lower real yields as central banks, whether it be due to growth concerns or fiscal dominance, get stuck behind the curve. In a financial world where noise is increasingly drowning out signal, following the money is as important as ever. Okay, so he's pointing out something super, super important, that we're getting a lot of money coming from China. But I would point out that through the whole post-COVID, or sorry, not post-COVID, the whole post-2008 world, we were printing a lot of money and we wanted inflation and we weren't getting it, right? So there are other factors. I'm a little bit skeptical. Well, first of all, I still think in that world we can come down 50 basis points, but it just might mean that we can only come down a little bit and then we have to hold rates there for a long time, which would kind of suck. But the other thing is that China's printing all that money because they've needed to stimulate their economy. It's been hurting. It's been hurting. And that's one of those things where it's like, okay, so global M1 increasing kind of suggests higher inflation. That does not necessarily mean lower stocks. This having the money around is probably a really, really good thing for stocks. So that's probably the bigger takeaway. Like the bigger play is probably to buy stocks, right? It's just there's this whole thing with the tariffs and everything, and should we be concerned about growth? I kind of feel like we're past the period where I'm concerned about growth. I don't know. Where's you know what? It's time to go. We'll talk tomorrow. It does make me wonder about long-term treasury holders holding now. But you know what? The bigger thing here is we were trying to figure out what was driving the buying this morning. And I don't think that I found a good answer. So hopefully today, at the end of the day, we get a better idea of what it is and we can discuss it tomorrow. But it seems to me like we're at a key inflection point in the markets and that I need to be doing a little bit more digging about what's going on and I might need to adjust my strategies. Might need to take some money out of treasuries and put it into equities. Well, that would suck because it would have been better to have done that earlier, right? But I've benefited significantly from the rise too, but all right. Well, and the treasuries are kind of falling off. Maybe a little bit of selling. We'll see if it has legs, but doesn't seem too big of a deal. And there's business inventories. I don't know. Very interesting, guys. A whole lot to think about. So I'll leave you guys with that. I will see you tomorrow. In the meantime, stay